Lehman Brothers survived 158 years on one principle: adapt or die. In 2008, they chose neither. By 2007, Lehman controlled more than $600 billion in assets. For every dollar of its own money, it had borrowed more than 30. A 3% drop in asset values was enough to erase the firm's equity. The balance sheet investors saw was not the balance sheet that existed. This is how a 158-year empire collapsed in 72 hours. In 1850, three brothers from Bavaria arrived in Alabama with almost nothing. Henry, Emmanuel, and Mayer Lehman started as cotton traders in Montgomery. Within a decade, they had expanded into commodities brokerage. By 1858, they had opened an office in New York. By 1900, Lehman Brothers was underwriting railroads, industrials, and department store chains. By the 1920s, they had helped take companies like Macy's and Sears public. By 2007, Lehman Brothers was the fourth largest investment bank in America, with offices in every major financial center on Earth. But the firm that survived the Civil War, 2 world wars, the Great Depression, and the savings and loan crisis had built something dangerous inside itself: a leverage machine. Here is how leverage works. Imagine you have $1, you borrow 9 more. Now you control $10 in assets with just $1 of your own money. That is 10-to-1 leverage. If your assets rise 10%, you double your money. Your $1 becomes 2. But if your assets fall 10%, you lose everything. Your equity is wiped out completely. Now multiply that principle. By 2007, Lehman was not leveraged 10-to-1. It was leveraged 31-to-1. For every dollar of equity, the firm had borrowed 30 more. Depending on how you measure, using tangible common equity instead of total shareholders' equity, some calculations put the figure above 40-to-1. At 31 times leverage, a 3% decline in asset values wipes out your entire equity. At 40 times, the margin drops to 2.5%. The firm had become a machine that printed profits in good times. In bad times, it would print destruction. And Lehman had concentrated that leverage in one sector: real estate, commercial properties, residential mortgage securities, structured products backed by subprime loans. By early 2008, the firm held more than $110 billion in real estate exposure. That was nearly 4 times its total equity. The entire firm was a leveraged bet on American property prices continuing to rise. When Bear Stearns collapsed in March 2008 and was sold to J.P. Morgan in a government-assisted rescue, markets began to question every investment bank's balance sheet. Lehman's stock dropped. Its borrowing costs rose. Counterparties demanded more collateral. The leverage machine was under pressure from every direction. And that is when investors discovered something troubling. The balance sheet they had been shown was not quite real. To understand what happened next, you need to understand a transaction called a repurchase agreement. A repo is simple. In a normal repo, a bank temporarily sells securities to another party for cash. The bank agrees to buy those securities back a few days later at a slightly higher price. The difference between the sale price and the repurchase price is effectively an interest payment. For accounting purposes, this type of transaction is treated as a loan. The securities stay on the bank's balance sheet because everyone understands they are coming back. Lehman used repos constantly. They were a standard part of Wall Street plumbing. Every major investment bank used them to manage short-term funding. But Lehman also used a special variant that most of their competitors did not. Internally, they called it Repo 105. In a Repo 105 transaction, Lehman did something economically counterintuitive. Instead of providing $100 in securities for $100 in cash, Lehman provided $105 in securities. It gave more collateral than it received in return. Usually, a borrower wants to post less collateral, not more. Why would any borrower deliberately overpay? Because that extra 5% triggered a different accounting treatment. Under certain interpretations of the accounting rules, if you provide at least 105% collateral, The transaction can be classified not as a loan, but as a sale. And if it is classified as a sale, the securities leave your balance sheet entirely. Your reported assets drop. Your reported leverage drops. Your balance sheet looks healthier than it actually is. There was a problem. No American law firm would sign an opinion saying these transactions qualified as sales under United States law. The economic substance was clearly borrowing. The assets came back within 7 to 10 days. The intent to repurchase was predetermined from the start. American lawyers looked at the transactions and saw through them immediately. But English law had different rules. A London law firm called Linklaters provided an opinion that under English law, if equivalent assets were returned rather than the exact same assets originally delivered, the transaction could qualify as a true sale. Lehman structured the transactions through its London subsidiary, Lehman Brothers International Europe. American securities flew across the Atlantic to London, got stamped as sales under English law, and the consolidated results flowed back into Lehman's United States financial statements that investors relied upon. The Valukas report, prepared by the bankruptcy examiner Anton Valukas, documented the scale of this practice. In the fourth quarter of 2007, Lehman used Repo 105 transactions to remove $38.6 billion from its balance sheet at quarter end. By the first quarter of 2008, the figure had grown to $49.1 billion. By the second quarter of 2008, it had reached $50.38 billion. That is roughly the entire gross domestic product of Bulgaria, temporarily moved off the books every 3 months just before reporting dates. The examiner also found that Lehman had established an internal limit of $22 billion for these transactions. Management exceeded that limit in every single quarter from 2006 onwards. By mid-2008, actual usage was more than double the internal limit that was supposed to control it. Internal communications tell the story plainly. In July 2008, a Lehman accountant asked a colleague what Repo 105 was actually for. The response was direct. It is basically window dressing. We are calling repos true sales based on legal technicalities. The accountant then asked if the rest of Wall Street did the same thing. The answer was a single word: no. Another senior executive described the practice differently in an internal email. He called it another drug we are on. The effect on reported leverage was material. In the second quarter of 2008, Lehman reported net leverage of 12.1 times. Without the Repo 105 adjustments, the actual figure would have been 13.9 times, nearly 2 full points higher. The difference between what was reported and what was real was large enough to change how investors and counterparties assessed the firm's risk. None of this was disclosed to investors. The examiner concluded that sufficient evidence existed to support what he called colorable claims that the financial statements were materially misleading. But one person inside the firm did try to raise the alarm. Matthew Lee had worked at Lehman for 14 years. By 2008, he was a senior vice president in the finance division. On May 16, 2008, he sent a formal letter to senior management citing the firm's own code of ethics, which required employees to report unethical or potentially unlawful conduct. He wrote that the books and records contained approximately $5 billion of net assets in excess of what was actually being managed at month-end. Ernst & Young, Lehman's outside auditor, interviewed Lee on June 12, 2008. During that interview, Lee told them directly about the Repo 105 transactions and the scale of their use. The very next day, June 13, Ernst & Young met with Lehman's audit committee. According to the bankruptcy examiner, they did not mention Matthew Lee's Repo 105 concerns to the committee. Later that same month, Lee was terminated as part of what Lehman described as firm-wide layoffs. 3 months later, the firm filed for bankruptcy. If you are watching this and thinking about professional duty and what it requires, consider the question carefully. When an employee tells the auditor about $50 billion in quarter-end balance sheet adjustments that are not being disclosed, what does professional obligation require? Ernst & Young maintained that the Repo 105 transactions complied with applicable accounting rules. The bankruptcy examiner found sufficient evidence supporting claims of professional malpractice. If you are here for the mechanisms behind how dynasties rise and fall, subscribe. That is what this series examines. September 12, 2008. Friday evening. The chief executive officers of every major Wall Street bank were summoned to the headquarters of the New York Federal Reserve. Treasury Secretary Henry Paulson delivered a clear message. There would be no government bailout for Lehman Brothers. The only options available were a private sector solution or bankruptcy. Bank of America had initially been interested in acquiring Lehman, but Chief Executive Officer Ken Lewis wanted a government backstop of roughly $65 billion to cover potential losses on Lehman's real estate portfolio. Paulson refused to provide government support. Bank of America withdrew from negotiations. That left Barclays as the only remaining potential buyer. The British bank had studied Lehman's business before the crisis. Bob Diamond, who ran Barclays' investment banking operations, believed Lehman's equities franchise would be valuable if acquired at a distressed price. Through Saturday, a consortium of Wall Street banks worked together on a deal structure that would allow Barclays to acquire Lehman. By Saturday night, an agreement appeared close to completion, but there was a problem developing across the Atlantic Ocean. Under United Kingdom listing rules, an acquisition of this size and significance was classified as a Class 1 transaction. Class 1 transactions require approval from the acquiring company shareholders in a general meeting. Organizing a shareholder vote takes 30 to 60 days under normal procedures. Barclays could potentially bypass the shareholder vote requirement if it obtained a special waiver from the Financial Services Authority, the United Kingdom financial regulator. But to grant that waiver, the Financial Services Authority wanted Barclays to guarantee all of Lehman's trading obligations from the moment the deal was publicly announced until it formally closed. That meant potentially unlimited liability for an undefined period of time, while shareholder approval was still pending. Sunday morning, Barclays Chief Executive Officer John Varley and investment banking head Bob Diamond contacted Henry Paulson, New York Federal Reserve President Timothy Geithner, and Securities and Exchange Commission Chairman Christopher Cox with difficult news. The Financial Services Authority had declined to approve the deal without the guarantee requirement. No guarantee meant no regulatory waiver. No waiver meant no acquisition could proceed in time. Paulson then called United Kingdom Chancellor of the Exchequer Alistair Darling directly. Darling later testified to investigators that he had effectively vetoed the transaction. His reasoning was straightforward. If Barclays had acquired Lehman & Lehman, then collapsed the following week, British taxpayers would have been on the hook for the losses for generations to come. There is a question worth considering here. When regulatory frameworks differ between countries, and a deal structure that might work under one legal system cannot work under another, who bears responsibility for the outcome? This was not a failure of negotiation or willingness. It was a collision of incompatible legal architectures that could not be resolved in a single weekend. Sunday evening, Lehman's board of directors was informed that the firm could not secure sufficient funding to open for business on Monday morning. The board voted to authorize a bankruptcy filing. At 1:45 in the morning on Monday, September 15, 2008, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court. It was the largest bankruptcy filing in American history at that time. The company listed $639 billion in assets on its petition. The very next day, Tuesday, September 16, the Reserve Primary Fund made an announcement that sent shockwaves through global finance. This money market fund held $785 million in Lehman Brothers commercial paper, just over 1% of its portfolio. it announced that its net asset value had fallen below $1 per share. This was known as breaking the buck. It was the first major money market fund to do so in 14 years. Within 48 hours, panicked investors had submitted redemption requests totaling more than $40 billion from that single fund. Within 1 week, more than $300 billion had fled from prime money market funds across the entire industry. The commercial paper market, which corporations depend on to fund their day-to-day operations like payroll and inventory, froze almost completely. Treasury Secretary Paulson later observed that without functioning commercial paper markets, factories across America would have had to shut down. The same government that had refused to provide a bailout for Lehman Brothers announced a $50 billion federal guarantee program for money market funds just 4 days later. The Valukas report, when finally completed, ran more than 2,000 pages across multiple volumes. It found that sufficient evidence existed to support colorable claims against senior executives for signing materially misleading financial statements. It found colorable claims against Ernst & Young for professional malpractice in their audit work. But the report did not find evidence that the examiner believed was sufficient to support criminal fraud charges. The distinction between civil and criminal liability matters enormously here. Civil liability for securities violations requires proving that statements were misleading and that executives acted with at least recklessness in making them. Criminal liability requires something more difficult, proving intent. Proving that executives had deliberate knowledge that they were deceiving investors and chose to deceive them anyway. The Securities and Exchange Commission investigated the Lehman collapse for more than 2 years before closing its investigation without bringing charges. Securities and Exchange Commission Chairwoman Mary Shapiro reportedly expressed frustration with the outcome. She said the world will not understand why no case was brought. Ernst & Young paid a combined $109 million across multiple civil settlements in 2014 and 2015. They admitted no wrongdoing whatsoever. The directors and officers of Lehman Brothers paid $90 million to settle the claims against them personally, but the entire settlement amount was covered by directors' and officers' liability insurance. The executives themselves contributed nothing from their personal assets. For perspective and comparison, consider what happened in Iceland following its own financial crisis in 2008. Iceland prosecuted 36 bankers in connection with their banking collapse. Those bankers received combined prison sentences totaling 96 years. Iceland created a dedicated special prosecutor's office specifically to handle crisis-related cases. The Icelandic parliament voted to relax bank secrecy laws to give prosecutors access to evidence. And critically, the Icelandic government allowed its major banks to fail rather than bailing them out, which gave investigators full access to internal records. The question to consider is not whether Lehman executives were villains in some moral sense. The question is, what legal systems actually require to establish accountability when following technical rules produces results that mislead investors about the true condition of a company? Public pension funds absorbed significant losses from the Lehman collapse. Ohio's state pension systems alone lost $480 million. Teachers, police officers, firefighters, and municipal workers had retirement funds that held Lehman securities, and those securities became nearly worthless overnight. Matthew Lee, the senior vice president who formally raised concerns about balance sheet irregularities in May 2008, spent years after the bankruptcy living off his depleted retirement savings and was unable to find work. The auditors who received his warning about Repo 105 settled for $109 million without admitting they did anything wrong. Regulators did eventually close the specific loophole that enabled Repo 105. In 2011, the Financial Accounting Standards Board issued new guidance that eliminated the effective control exception, which had allowed those repurchase transactions to be classified as sales rather than financing. The specific mechanism that Lehman used to dress up its balance sheet no longer exists under current accounting rules. But the lesson from this collapse is older and more fundamental than any single accounting loophole. Leverage amplifies everything. It amplifies profits in good times, and it amplifies losses in bad times. When the systems that measure and report risk are themselves distorted by the entities being measured, the machine does not recognize danger, and it does not slow down. It accelerates right up until the moment something breaks. Lehman Brothers did not fall because of fraud in the criminal sense, or because of villains, or because of any single catastrophic decision. It fell because of a system. Leverage magnified every exposure far beyond what equity could support. Accounting structures obscured the true picture from investors and counterparties. Regulatory frameworks could not bridge two different legal architectures across the Atlantic in a single desperate weekend. And a market that had finally stopped believing what it was being told. The next episode in this series examines a very different kind of machine. Where Lehman Brothers built leverage, the Ford Motor Company built vertical integration. It was the opposite strategic approach to the same fundamental question: how do you survive what you have built? If you found this analysis useful, subscribe now. The patterns keep repeating.